Welcome to the Marshall Institute and welcome to the LSE. And good morning if it's morning, and good afternoon if it's afternoon, and good evening if it's evening. One of the things that these digital convenings do is allow us to welcome people from all over the world, from different time zones. It means you don't all have to be in a rainy London this afternoon. I'm particularly delighted to welcome our friends from Oxford Said, from Cambridge Judge, from London Business School, from King's College London, our immediate neighbours. Welcome to all of you to Impact the University series. When the Marshall Institute was established, it was established to think hard about private action for public benefit. In other words, it was set up to think about impact. So we're particularly delighted to welcome Sir Ronald Cohen back to the Marshall Institute, back to the LSE. Of course, to welcome the director of the LSE, Baroness Minouche Shafik, to talk about the book that you can now see on your screen. If you've bought it and not read it, read it. If you haven't bought it, buy it and then read it. It's very important and it's very timely, and all the royalties go to charity. So welcome this evening. Minouche will engage Ronnie in conversation and ask him some questions, and he'll give you an overview of the book. Welcome, Minouche.
Thank you very much, Stephan, and welcome to everyone. It's a real pleasure to have Sir Ronald Cohen here to talk about his new book. And I'm very much looking forward to the conversation. Just a brief introduction. Ronnie, I think as he's known to his friends, is chairman of the Global Steering Group for Impact Investing and the Portland Trust. He's also co-founder director of Social Finance UK, US, and Israel, and co-founder and chair of Bridges Fund Management and Big Society Capital. For nearly 2 decades, he has pioneered initiatives in driving impact investment and catalyzing a huge number of global efforts, all of which have been focused on driving private capital to serve social and environmental good. And these efforts have led and contributed to the global impact investing movement. And the wisdom, I think, of all of that experience is synthesized in this book, which we're going to discuss this evening. So, Ronnie, welcome. And I'd just like to start with asking you to give us a sort of overview of the arguments in your book.
Well, thank you, Minouche, first of all, for having this conversation with me, with all our friends from the LSE and all the other universities that Stephan has mentioned. Thank you, Stephan, for hosting this at the Marshall Institute. So I think all of us, Minouche, on this webinar are aware that things can't continue as they are. We see a huge efforts being made by government at an environmental level and very little progress. We've also spoken for decades about reducing social and economic inequality, and we're going the other way. The gaps between rich and poor are becoming so large that we see the dissatisfaction erupt in violence in places as far apart as France and Chile and the Lebanon, and recently, of course, with the very sad events around Black Lives Matter in the United States. And I think you've been in government, and you know, I think governments have tried their best to try to tackle these issues, but the reason they haven't been successful is the issues don't really stem from our political system. Of course, in part they do, but not fundamentally. Fundamentally, the issues stem from our economic system, because we live within a system that has become self-defeating. Of course, capitalism has helped us through the power of capital and markets and enterprise and competition to take billions of people out of poverty. But it could do so without worrying much about the consequences that it caused in the pursuit of profit for a very long time. And for some decades now, we begin to realize that businesses and investors seeking to achieve profit without worrying about the damage they cause, and then governments having to tax us all in order to remedy these environmental and social consequences, just doesn't work. However much governments tax us, they can never cope with them. And so the book is about saying, capitalism, the power of markets and so on, is something that has a lot of positive aspects to it. But we can no longer let companies ignore the damage they're causing. And to put it in investment terms and in business terms, decision-making has to shift from 2 dimensions, risk and return, to 3, risk, return, and impact. And the breakthrough that technology has allowed us to make and big data with it is in measuring the impact of companies. And that's something that many people on this call will not be aware of, that the metrics that different organizations have worked to assemble over the years, tons of carbon and so on and so forth, carbon emissions, are now being translated into monetary terms, capable of being included in the financial accounts of companies. And so an effort which I am privileged to chair at Harvard Business School, the Impact Weighted Accounts Initiative, has shown how we can measure the impact from a company's operations, from its products, and from its employment on people and planet, and turn this into monetary terms. And the book is about how this measurement of impact is going to lead to a reshaping of capitalism, how it's basically going to move the goalposts for businesses and for investors away from just measuring their profit performance to measuring their profit and their impact performance. And this is, in my view, the next frontier for society and for our economic system. And it holds out the prospect of reducing the inequalities that plague our society and preserving our planet.
So in the book, Ronnie, you talk about both positive impact of corporates and their negative impacts, and the importance of measuring them properly. How do you go from that measurement to changing the way they behave and invest and act in society?
So to give you an example of what transparency contributes to achieving this improvement, the Harvard data to which I referred, which by the way, all of you can access, it's open source at Harvard Business School, Impact Weighted Accounts, IWAs, you'll see data set, you click on that. You will see data covering 1,800 companies, and we're about to add another 700. And that data covers the environmental damage caused by these companies. Very few of them have positive environmental impact, by the way. If I say to you, Minouche, that as a group, they create $3 trillion worth of environmental damage in a single year. And if I add to that, that 250 of them create more environmental damage in a year than they make in profit. And that 600 of them, a third, create environmental damage equivalent to 25% or more of their annual profit. Then you can begin to see how you can create a race to the top, because what is beginning to happen already, the data at Harvard shows it, is investors are leaving the firms that are creating the most damage to go to their competitors. You can already see a correlation between high environmental damage and lower stock market valuations, Minouche. And so the $30 trillion of environmental, social, and governance investment, which seeks to achieve impact as well as profit, but doesn't measure the impact created, and the $1 trillion of impact investment today, which both has the intention but adds to that the measurement of the impact created. Those more than $30 trillion have already tilted the scales, and that begins to engender a dynamic which improves the world, because it doesn't stop at environmental damage. The Harvard data covers employment impact. It measures the cost of diversity, the cost of differences in pay according to gender or minority group. It also measures the impact of the product of a company on health as well as the environment. So if you imagine a world where you pick up the annual report of a company and you see its profit and loss statement and its balance sheet, and then you see impact weighted profit and loss statement, profit, loss, and impact statement, and the balance sheet that also includes the impact that the company has accumulated, then you begin to understand that our system really can change, and it has very deep implications, actually, then for the business models of companies, because companies that pollute heavily, ExxonMobil is a good example. ExxonMobil is the worst of the polluters. It just through its environmental footprint, Minouche, you can see in the Harvard data, it creates $39 billion a year of environmental damage, compared to Shell, which creates 23, and BP, which creates 13. If you look at the share price of ExxonMobil, it's gone from 500 billion 3 years ago to 140 billion today. And the reason is investors understand that this must mean a bigger risk of ExxonMobil being taxed and regulated, of talent leaving it, of customers leaving it. And so you engender a dynamic which, instead of creating profit and damage at the same time, creates profit and positive impact for society and the environment. It moves the goalposts for businesses and investors.
So you say that the balance is tilting, and the impact investment community and the ESG community is moving their money with this data. I guess the question I have for you is it tilting fast enough? And one of the criticisms is that the impact investing, ESG investing community is still very small. One of the people I admired who passed away sadly was the head of BRAC, the Bangladeshi microfinance and NGO, Faisal Abid. And Faisal used to always say, small is beautiful, but big is necessary. And we need scale, and it's still a very small share of the total investment community. How do you see that, and how do you see achieving scale?
So I think there's been a transformation over the last 6 or 7 years. At the time when we wrote the G8 Task Force report in 2014 on social impact investing, and I commend it to all of you who are interested. It's entitled The Invisible Heart of Markets. The amount of money which was flowing in ESG was just a few trillion. Today, it's more than $30 trillion. representing the equivalent of a third of all professionally managed money in the world. Now, it doesn't measure impact today because it doesn't have the tools to do so. But if you give it impact transparency, that is going to become heavily impactful. We wrote a chapter in the report entitled The First Trillion. If Minouche had said to me that's going to happen within 6 years, I would have said, wow, I mean, that's really going to take some going. So it's accelerating, and I think COVID is accelerating the transition to impact, because not only is it shaping habits and beliefs and leading us to question capitalism, democracy, and and everything else, and so making us more open-minded about changing our system, but it is such a huge problem, COVID, in terms of its economic consequences. For government, it's going to mean that governments are more heavily loaded with debt than they've ever been. Their budgets are going to be very heavily constrained as a result. In terms of social issues, Minouche, you know better than I do. The social issues are going to mount inexorably as unemployment levels are high for a sustained period of time. It leads to greater poverty, to greater homelessness, and all the afflictions that stem from poverty. So how can governments reconcile this greater need for intervention and less money to devote to it? Well, the answer is only by bringing companies and investors alongside to stop creating problems and to start providing solutions.
So we've already got some questions coming in, and I'm going to use one of them because it directly follows from what you've just said from Ellie Nielsen, who's an LSE student currently in Seattle. And the question is, how do you achieve scale with impact transparency but avoid corporate greenwashing? How do these old, bigger companies, how do you hold them to account to stick to their impact goals? You must have seen the issue many times.
Many times. And the answer is you can only do so by having real transparency on the impact created. What does that mean? It means that every company has to report according to the same generally accepted impact principles, all of the impacts that it creates, and that these numbers are audited, and that a company can no longer make claims. Investors, employees, consumers can look at it. So if you're in the UK and you go to the shelf of your supermarket to buy a box of Twinings tea, you'll probably point your phone at it and it'll tell you Associated British Foods, which brought this tea to your shelf, creates $1.8 billion of environmental damage in a year, while it only makes $1.6 billion of profit. That is going to change your attitude to Associated British Foods. No amount of greenwashing about the wonderful things that Associated British Foods does in other ways, is going to be able to convince you that the damage isn't being created. Now, it's important that we don't just measure environmental damage, of course. If we really want to change the behavior of companies, we have to give a fair assessment of all the impacts that companies create. We have to measure their employment impact and their product impact too, so that you're able to say, by looking at the company's accounts, this company is net impact positive or net impact negative.
Is transparency enough? Because I think, how do you empower that consumer who's walking along the supermarket shelf? They probably won't read the annual report of that company. How will they know? How do you use the leverage of consumers more powerfully? And is government regulation ultimately necessary?
So I think consumers are going to have apps on their phones that are going to enable them to point their phone at the barcode of a product and get the sort of information I've described about the company manufacturing the product or bringing it to your shelf, as well as the impact of the product environmentally and health-wise, and and so on. But your point about government is an extremely important one, Minouche, because the information in the Harvard data set is public information made available by companies, not always on the same, on the same basis. And so we had a situation like this in the early 30s with regard to profit. After the crash of 29, investors sat up and realized that they'd been investing in companies which had each picked its own accounting policies with no one to verify the numbers that were published. And in fact, in those days, Minouche, as you know, companies could squirrel away part of their profit into hidden reserves without telling shareholders. So investors woke up and said, we've lost a ton of money in the crash of 29. Part of the reason that we didn't really understand the financial position of the companies we were investing in. Yeah. And so in 33, big crises create the background for big steps forward. The US introduced generally accepted accounting principles. When people were saying, how can you have a single principle or a set of principles for every company, irrespective of size and sector? It'll spell the end of American capitalism. The US government was bold enough to impose it. And you had securities legislation just 3 years later in 33, which introduced GAAP accounting, as it's called, and the use of auditors. I think we're exactly at the same crossroad today. Government must step in to mandate that companies publish impact-weighted accounts according to generally accepted impact principles. And these numbers must be audited. Now, if governments did that today, then and they required companies to start publishing these accounts 2 years from now, so that at the end of the 3rd year, you could look at impact-weighted accounts of companies. There's enough information around how you do it and the frameworks for doing it, and at Harvard and elsewhere, that the accounting profession could deliver that. So government is necessary. We can't continue with voluntary publication of information by companies on completely different bases sometimes.
So let me ask you just to develop that theme a bit further on government's role. Clearly, there are big international, global capital markets are very international. These major corporations have international presence. There is an international coordination problem here. And it would be interesting to hear you say a few words about how that coordination problem could be solved.
So in an ideal world, Minouche, we would ask the G7 and the G20 leaders to publish a declaration saying that they would all mandate impact accounting for companies, which would enable investors to have the same access to impact transparency. In today's world, particularly with President Trump at the helm of the United States, that had become impossible. It may be that with Joe Biden as the next president, this will change. But it's interesting that in 33, when the UK was the dominant power, it wasn't actually the UK that introduced this, it was the United States. And so today, it could be the EU, which has, as you know, been pushing for several years now for environmental transparency on the impacts created by companies, but has stopped at the level of reporting. And so we'd have to take a step further and say, this is part of the resilience agenda of the EU. Resilience means environmental and social, and impact accounting must provide us with a clear view of both impacts. So it would involve a big step for the EU. Or it could be that the UK would lead. The UK will preside over the G7, 7 years after we had the G8 meeting presided over by David Cameron. Yeah. Perhaps the UK will put this on the agenda. It ought to. If it's not the UK, perhaps it'll be the Netherlands or Denmark or one of the other Scandinavian countries, or perhaps Canada or New Zealand, which have all sort of moved in the direction of impact. So it may be that a group of smaller countries becomes the catalyst for it.
Let me ask you, there are several sort of, I don't want to call them competing, but there are many proposals out there about how to do this better. There's the sort of Mike Bloomberg, Mark Carney, financial transparency around carbon and environmental impacts. One of our questioners, Conrad Hudson, asks, the big four consulting firms and Bank of America introduced ESG stakeholder capitalism metrics at the World Economic Forum. There are many proposals out there. Are there any one that you would particularly emphasize as being the most promising?
So the first thing to say is many of these are converging now. Many have been focusing on carving a piece of the puzzle without having a picture on the puzzle, if you like. The picture on the puzzle is the destination. The destination must be a user-friendly way for investors in particular who have the biggest influence on the behavior of companies, bigger than governments today. For investors to be able to use this information and apply the tools of financial analysis. That means monetizing these impacts, not just measuring a ton of carbon, but putting a price on it so that you can then introduce it into a financial account and deduct negative impact from profit or add positive impact to it. So the first thing to say is now people are beginning to converge. The metrics have been around for environmental impacts for some decades now. They've been building up and they're at a good stage of development now. Social impacts are catching up. And we just have to take this additional step of adding monetization to these metrics so that investors can use them easily. So they're all converging. And I would say the disagreement exists today between the gradualists who say, well, we have a bird in the hand. It's reporting, not measurement through accounting of environmental impact only. Let's grab that and be satisfied with it. And those who say, no, like 1933, if we want to cope with the major environmental and social issues we face, and if impact transparency through accounting is the way to achieve that, that's what we need. We shouldn't satisfy ourselves with something which will not be capable of changing the behavior of companies. And so I think the thinking around resilience today, which is central to a lot of governments thinking, how do we increase our ability as societies to cope with social challenges and environmental challenges, may well be the way that we unite to these two streams, the environmental and the social, and the metrics and the monetization. So to answer your question, the work that's been done at Harvard builds on all the work that's been done by SASB, by GRI, by CDC, by the GIN, by B-Lab, and by others. It could not have done that work. The Impact Weighted Accounts Initiative team could not have done that work without this foundation. Adding monetization to that was thought to be very difficult, and it's now showing, that work is showing that it is not that difficult. And it's beginning to be understood, I think, within the accounting profession, that this is something that can be implemented, certainly within a 2 or 3 year time frame. So I think, I think we're getting to the moment of reckoning.
So there's a question actually that's coming that follows from that, from Julia Morley. Is it desirable to standardize impact measures across different sectors in different countries? Example, ABF versus Exxon. And who is competent to audit impact disclosures? Who's going to actually do the work? Okay,
so the answer is you can't apply all of the same metrics to all sectors. And the Harvard effort, for example, is looking at 11 sectors and measuring the impacts and on a comparable basis for companies within it. So like financial accounting, there are some accounting rules that apply only to the software industry on recognition of revenues, for example. There are some more general changes in accounting rules. And by the way, the financial accounting system is going through changes in rules on a monthly basis. It's not a Procrustean bed. It's a living, system. And so I think the answer is we're capable of doing with impact accounting what we did with financial accounting, which is to have generalized principles and then some principles that are specific to specific sectors. The auditors will be the same auditors who are auditing today financial information. They will have to bring some additional expertise in-house to do it, but many of the big accounting houses, in fact, all of them in one way or another, have been pushing in this direction for some years. Yes. So you will have
building up capacity in this area already.
Yeah, and you will have an auditing firm auditing both your financial data and your impact data.
Let me turn to the sort of the upside arguments around impact investing. There have been many claims that investing with a sort of ESG lens actually generates higher returns.
Yeah.
Many disputes around this, how you measure it, et cetera, et cetera. I just wondered whether what you thought about those arguments and what your experience is with those arguments.
Now, as you know, I spent my career in venture capital and private equity, which some people would describe as the very hard-nosed end of investing. I am firmly convinced that optimizing risk, return, and impact will deliver better financial returns, better than just optimizing risk return. Let me explain why, Minouche. When you introduce impact alongside risk and return in making a decision, you affect both the return and the risk side. What do I mean by that? Let's start with the risk. A company which is polluting heavily may get taxed, may get regulated, its activities may get banned or constrained or whatever. We already see famous investment managers like the Yale Endowment Fund writing to their portfolio company CEOs and saying, measure your carbon footprint. We want to know what it is because a carbon tax may be introduced, okay? So that's one risk. Another, the risk of regulation and taxation. Another risk is that talent leaves you. Because talent today, especially young talent, like many on this webinar, doesn't want to work for companies that are making money, but creating harm. It's just not their view of their moral obligation to do the right thing. Okay, so you have that, and then you have customers leaving you. Customers are leaving combustion engine cars to buy to buy Teslas. Tesla is worth more than General Motors today. Single-handedly, it has changed the whole of the automobile industry. Mm. So entrepreneurs are going to come in now, just as tech entrepreneurs did 3-4 decades ago when I was in the middle of my 20s and created what became Apex Partners. And they're going to disrupt the models of many industries, and they're going to overtake leaders in these industries as Apple and Microsoft overtook IBM. So you have a risk of disruption as well.
Do you think that one of the arguments that you hear is that the higher returns that we observe actually don't have anything to do with impact? For example, I've seen this argument around diversity. Companies with more diverse boards and diverse management tend to perform better and have higher returns. But then the other argument is, well, actually, it's just because they've got more switched on management. And it isn't the diversity per se. It's just that their managers are better at being open and dynamic. And so in some sense, it's proxying something else. But maybe you would argue it doesn't matter.
I would argue it doesn't matter. The issue of attribution, if we're actually improving diversity and the companies with diversity are led by more enlightened, better managers who deliver better growth and better profit, it's all fine for me. I firmly believe that having different opinions, different backgrounds, different values around a decision-making table leads to better decisions, But the reason, though, that risk-return impact is going to deliver, better returns is because at the end of the day, you've avoided some risk, but you've also, by putting on an impact lens, begun to discover new product market opportunities that you wouldn't have discovered if you hadn't put on an impact lens. For instance, let's take the banking industry. If you create a fintech platform today to help those who are at the bottom of the economic pyramid to manage their lives better, that platform may well be the disruptor of the whole of the banking system, because that platform will avoid expensive overdrafts, will enable you to manage your expenditure better by analyzing your revenues and the things that you're spending on. It may lead to the definition of financial products that are more appropriate for people who are not so well off. And so I can give you other examples, but I don't want to take much more time. You really do discover completely different sets of opportunities.
It's interesting. Just a couple of examples to support what you're saying. We've had, our endowment is very modest at the LSE, but we have written to all of our fund managers and asked them to report back to us on a whole bunch of ESG things, and removed our money from those who, there were a couple that didn't want to engage on the issue and didn't want to report explicitly. And so we withdrew our money from there and moved it to others. And, each of these pressure points, I think, moves the dial just a little bit on the industry.
And interestingly, the University Superannuation Fund is one of those that is taking impact seriously.
Well, seriously. And also, to be frank, also because our students really care, as do our staff. And on your point in talent, I remember the CEO of Unilever said to me that they get 1 million job applications a year, which is a huge amount. For graduates, because of their reputation and their ability, and the talent wants to go there because, exactly as you say, people want to work for organizations whose values they respect. So it's definitely a factor in the competition for talent.
And do you see a change of values in the student body of the LSE relative to previous generations?
Definitely. It's very interesting. It's both related to impact, but also to the kinds of jobs they want. It used to be, say 5-10 years ago, the biggest student society at the LSE was the Investment Banking Society. Today, it's the Entrepreneurship Society. And the entrepreneurial projects that they are interested in are ones with an economic and social impact. And so there is a sort of move away from those traditional employers, large organizations, only about making money.
Well, you know, you confirm what I wrote about in Impact, that this impact revolution is going to resemble the tech revolution in that it is going to be led by young people who define different business models that enable them to do good and to do well at the same time. It's very, very heartening to hear that you feel that, because you're right at the front line.
Yes. Let me turn to one of the questions in the chat from Raffaele de la Rochefoucauld. Which companies, investment PE funds or consultancies are the most ahead in terms of aligning impact, risk, and return?
So you have two categories of companies today. You have the new entrants, say in the investment world, who set themselves up, in the case of some of them as long as 20 years ago almost now, to optimize risk-return impact. And in that category would be companies like Bridges Fund Management, which I'm honored to have co-founded, which manages today more than £1 billion a year. Leapfrog, which has invested in Africa, in financial product companies. Avishkar, which has invested in India. Double Bottom Line, which is a West Coast venture capitalist that invested in Tesla and SolarCity and SpaceX, and so on. And then you have those who have been established leaders of traditional investment, who've understood this ahead of others. And BlackRock, $7 trillion under management. Larry Fink famously sent a letter in 2018 to the CEOs of companies in their portfolio saying, and they invest in almost every company in the world, saying, if you want to prosper, you're going to need to deliver positive impact as well as a profit. You have, I didn't mention one new entrant in public securities, Generation Investment Management, set up by David Blood and Al Gore, which is now a $20 billion investment manager, totally about risk, return, and impact. And you see the big private equity firms now, KKR, Bain Capital, TPG, Blackstone, Apollo, all raising impact funds. So you have two categories. You have those that started with the right DNA, if you like, from the very beginning, and you have those who started with very traditional approaches, but actually had the right DNA, I suppose you would say, and began to shift. Among consulting firms, I would say that all of the consulting firms are working on this, all of them, almost without exception. There isn't a boardroom in the world of a significant company that isn't thinking about impact, and they're turning to the consulting houses for advice. So I think the world is adapting to this new reality, because when you have a third of professionally invested money going to affect the behavior of companies, that isn't a flash in the pan. I mean, that's well beyond tipping point.
And let me ask a different question around impact bonds.
Yeah.
They were very fashionable at one point. The idea that you would structure bonds to do things ranging from bringing forward vaccine development, highly topical today, to improving the performance of prisons in rehabilitation.
Yeah.
I think it's fair to say they've had a mixed track record. I'd be very interested in hearing your views because you were involved in the early days.
Very much. I was involved in the first one and have been involved since. There are now a couple of hundred across the world. They've raised about $500 million. The outcomes payments on them are probably twice that. 500 million, so you're talking about $1 billion. They cover 15 social issues across 13 countries. And this method of pay for success is going to play a big role in tackling the biggest issues we face, like education in emerging countries, for instance. So there are efforts now, which I'm involved in, to create $2 billion outcomes funds, one for Africa and the Middle East and one for India, to tackle the education of about 10 million children in each place. And the power of the social impact bond can best be illustrated by the experience of an organization called Educate Girls in India, run by a wonderful social entrepreneur called Stephan. Stephan raised about 5-6 years ago $250,000 social impact bond to help girls under the age of 12 stay at school, not to drop out of school. And there are cultural issues, there are family issues, there are other pressures that lead girls to drop out. The social impact bond was funded by one of the bank's foundations, UBS Optimus Foundation, and the Children's Investment Fund paid for the results. Stephan beat her figures because there's a contract. We will pay you so much if so many girls don't drop out who would have dropped out, by 160%. What was the result? $100 million flowed to Educate Girls. Why? Because Educate Girls, under Stephan's leadership, showed that it could achieve real results. And entrepreneurs in the social area have not had the opportunity to do that before, to raise $100 million on the basis of data showing what results you've achieved. So the social impact bond has taken time to fashion because there's been no standardization. You've had to negotiate with the government, a different government very often, or a set of philanthropists for the outcome payment. You've had to raise the money from individual investors rather than funds. Now with these big outcomes funds coming, you're going to have outcomes funds with a lot of money, professional team can sign a contract quickly, standardized contract, maybe even on blockchain. And on the other side, you're going to have social impact bond funds run by people like Bridges and UBS together, interestingly enough, that seek out social entrepreneurs in the educational field who can really help young people improve their education. And interestingly, here in Israel, I'm speaking to you from Tel Aviv, there's a social impact bond to prevent students in the computer field, studying computing, to stay at university instead of dropping out. You'll be amazed, but even in a startup nation, more than 50% of the students drop out. Why? They come from poorer backgrounds. Sometimes they're Arabic speaking, rather than Hebrew speaking, and they drop out. And we're finding we can reduce the dropout rate by 1/3 to 1/2 by providing mentoring and helping students overcome the challenges they face. So I think pay for success is here to stay. But if you think more widely, what about bonds that deliver impact? Well, green bonds today are nearly $1 trillion. You know, you're talking massive amounts of money. We're beginning to see green bonds where the rate of interest falls if the company actually achieved the objectives it set at the time when it raised the money.
Yeah.
And so, you know, I mean, this is not, and this is once again a bit like venture capital, a case of a new instrument taking time for people to understand it, to bed it down, and so on. Let me tell you, when I kicked off my first fund in Europe, my first venture capital fund, in 1981, it was 10 million pounds. Apax had raised two funds of more than 11 billion euros. But it took us years to get there. I went, you know, I can tell you the first 10 years of Apax, from 81 to 91, were extremely difficult.
No, it's when I was at the Bank of England, we did quite a lot of work to try and standardize green bonds so that, you know, it became a more of, we knew we couldn't get scale unless there was a standardized product. Everyone recognized the terms and conditions, the contractual arrangements, the default arrangements, and so on. And by writing up a standard contract, which the markets could use, you then enabled much larger flows. As long as it was a boutique business, it was never going to be large.
Yeah, and you know, financial products are like that. They take time to bed down and fashion and standardize, and then when the demand is there, they really take off.
So let me turn to a question from Olivia Chowdhury, who asks you, as you mentioned, your area of expertise has been in the private equity space. Where do you see other non-finance-based areas of impact, like social policy and social work, having an influence in the world of social impact?
So I think impact investment transforms the philanthropic sector. That may sound odd, but the purpose of the social impact bond was to bring investment to non-profit organizations working to address major social issues. The first one, as you know, Minouche, was the Peterborough bond dealing with prisoner reoffending at Peterborough jail. The ability of an entrepreneur to raise investment capital is the reason companies have grown to be as big as Microsoft and, you know, and Apple and so on. But if you compare the growth of non-profit organizations, tiny. All non-profits virtually are tiny. I mentioned in the book, if you look at the number that have achieved growth beyond a certain level, it's a fraction of the growth achieved by private businesses. And so I think impact investment through charitable organizations provides the tools now to innovate and to scale beyond what the typical grant and donation model has enabled us to do.
Let me turn to a question from Will Oliver. It seems like government could accelerate conformity if they applied IWAI, I think that, where they interact with the private sector around procurement, privatization, regulation, tax credits, and incentives. What have been government's reactions and or participation in this work? Is it necessary for scale?
So governments so far have taken steps in the direction of impact. The UK government has been the world's leader, actually. Not only did we invent the social impact bond there, but the first social investment bank, big society capital, was set up in the UK. It was set up using unclaimed assets, which the government released. These are bank accounts that had been separated from their owners for 15 years or more. It included in its budget the social investment tax relief, which provided incentives for individuals to invest in social impact bonds and other ways of funding charitable organizations. It published the unit cost database showing the cost of 600 million social issues. It set up the G8 task force and so on. But governments haven't yet caught up with the thinking around the economy optimizing risk-return impact and the need for transparency, accounting transparency that is dependable and accurate. To achieve that, that is the next frontier. So I think governments are receptive to the idea, but the governments don't always want to lead the market. And so what is happening now is the pressure of consumers, of employees, and of investors, most importantly today, is creating an inevitable path to impact accounting transparency. And the reason is in the Harvard data. If you can see that this information is price sensitive, that it affects the value of a company on the stock exchange if it is polluting or if it has bad labor practices or uses child labor or whatever. And you can see information coming into the marketplace that some investors access and others don't, then regulators have a real problem. They have to step in to establish a level playing field for all investors in order to protect the interests of those who don't find it easy to access that information. And that's why I think, Minouche, we're going to see impact accounting transparency within the next 3 to 5 years, as we did in 1933, 4 years after the Great Crunch.
It'd be interesting to see whether governments apply it to themselves as well as to the private sector.
I think the governments will begin to measure outcomes rather than inputs, no doubt about it. And when they make investment decisions, we'll worry about the impact created. I was in India a couple of years ago, and government ministers were saying to me then that there were outcome budgets now, that government ministers were being judged on the number of kids who would actually graduate and the cost that it took to achieve an improvement.
Yes, when I used to run the UK's aid program, the Department for International Development, and we did quite a few sort of outcome-based aid programs where you would pay for, you know, every person trained and who got into a job and lasted in a job for a year, or you paid per child who succeeded to a certain level in their education. And yeah, and you can, you know, it's certainly from an accountability point of view very attractive politically, and financially often makes huge sense.
And DFID, where you led, which is now part of FCDO, has been one of the big drivers of this whole impact movement.
Yeah, absolutely. Let me ask you a different question. One of the things we've done here at LSE is something called the Transition Pathways Initiative, where we've been rating companies on their trajectory, on the journey toward ESG. So it's not so much saying we're going to have a negative screen and you shouldn't invest in this sector or this company. It's saying, where is this organization in terms of how it's moving toward better environmental and social impact? What is your view about taking a sort of a static view versus a dynamic view on both sectors and companies?
Now, I'm in favor of the transitional pathways view, because you want to help companies to transition to being impact positive. And you want to engage with them to help them to achieve that. What you don't want is to keep investing in companies that want to double up on a business model that creates negative impact.
Yeah.
And so if you see a company's management is focusing on the right thing, is measuring impact, is improving its impact performance by investing to reduce emissions and correcting discrepancies in pay and so on and so forth, then I'm very much in favor of engaging with it. But companies which believe that all of this is rubbish and that the purpose of a company is simply to make money without worrying about the damage that it causes environmentally or socially, I think if we want to change those companies, we have to move away from them.
Let me turn again to some of the questions. We've got several more questions coming in. One from an anonymous person who's saying, working with the private equity businesses within infrastructure and real assets, will adopting a more forceful stance on ESG metrics affect their underlying returns mid-cycle?
You know, I don't believe so. I mean, obviously, you have to be a good investor as well as good at understanding impact and achieving it. Somebody who is a bad investor will not achieve very good returns just because they look at impact. But as I said earlier, even within infrastructure, I think optimizing risk-return impact will lead to better return.
Mm-hmm. It's another one from someone from the London Business School, Juliana Zero. What else besides transparency and metrics does the impact sector need to be really big and scalable? What are the urgent needs? More talent, more entrepreneurship ideas, more attention? What else?
Well, we need a regulatory tweaking. Tweak, yeah, which comes back to government about the duties of company directors and trustees of pension funds and funding. But, you know, and the UK had 2 law commission reports on this, and the law, in theory, enables trustees and company directors to optimize risk-return impact, but the message isn't clear, and you have decades of history that make directors and trustees very concerned about their legal liability if they take anything other than financial considerations into account in their decision making. So we need that, and it's not a big job. You need to shift from may take these things into consideration to must, you know. So that we're not talking of a complete overhaul of corporate law. The other thing that we need today is allocations from investors, pension funds, and asset managers to ESG and to impact investment. It's those allocations. So an allocation to impact would get capital flowing to impact venture capital firms that are, you know, that are setting up and believe in this. It's been very difficult to raise money for impact venture capital all these years because the allocations within the pension fund that would invest in venture capital didn't sort of include the concept of impact. If you can now open that up, then you will see all the venture capital eventually go to impact venture capital, but you'll quickly see it, in my view, go to 30% of all venture capital.
Interesting.
Similarly with private equity. So I think these investor allocations are very important. But what is going to drive this impact revolution at the end of the day is entrepreneurs whose business models deliver more profit and more impact at the same time. And so,
sorry, go ahead.
Please.
Well, there's actually a question in the chat from Santiago Sanchez on pension funds and how can they be motivated to invest in social businesses. When you argue for an allocation, do you mean a sort of ex-ante proportion that is allocated, earmarked to ESG, or would you allow it to be a bit more fluid than that?
No, so I mean the way investors work, as many of you will know, is they define according to a model how much they should invest in every area, and then they go out and they look for opportunities that fit within venture capital, private equity, public markets, stocks, bonds, and so on and so forth. If you don't have an allocation that makes it clear that you can optimize risk-return impact, then when you go to the person in charge of the venture capital allocation, they'll tell you, well, that's not my remit. Impact isn't my remit. Impact venture capital is something new and highfalutin. It's not for me. That's what I mean.
I see. It's a question from Tom Strelchak. As someone who works in executive search, asset manager clients often complain of a distinct lack of ESG or impact professionals in the market compared to demand. What areas are most advantageous for aspiring professionals to transfer from without existing experience in this growing sector?
I mean, it's a good question. I think the answer is that any sophisticated thinker who has been to the sorts of universities that are represented in this webinar, wherever they come from, they can have read classics and become extremely well versed in the issues of impact. What you need is the passion for the subject and the desire to devote your career to becoming a leader in it.
Okay. So let me turn to where progress can be made. And one question is kind of where will the rules be set and which markets are going to be where the action is. I know that at various points, the City of London aspired to be the sort of green investment capital of the world, and the definition of what a green bond looks like and so on was done in London with the financial community there. Do you think it's necessary to have a sort of locus of expertise, and where do you think that should be?
So I think expertise tends to accumulate in some places rather than others. And I think the City of London is very well placed to be a global leader in this field. But there will be competition from other marketplaces, obviously competition from all of the financial marketplaces. It could be competition from the United States, competition from Germany, from France, from Singapore, from China. Everybody, I think, is going to play a role in this market eventually. The opportunity that the City of London has is that the UK has actually developed the most developed ecosystem for impact investment. It has the longest track record of thinking about it. And so it provides an opportunity for the city, particularly with the disruptions that Brexit is going to cause to some of the city's activities, which are going to inevitably gravitate towards the continent, particularly those associated directly with the currency of the euro. So I very much hope that the city, which has certainly flown the flag of environmental impact and has supported the efforts around developing impact investment. The G8 task force meetings, took place in the city, and the GSG's meetings, the Global Steering Group for Impact Investment, also started with meetings in the city. So I would say that the roots have already penetrated the city, and I hope that the city will now espouse this new optimization of risk-return impact and throw its weight behind achieving the next, the next step towards this new frontier for society and capitalism, which is impact transparency.
So maybe, Ronnie, maybe just a final question for you. You started off talking about the COVID pandemic and how it has revealed all of these fundamental problems in our societies. Maybe just a final word from you on how you think this pandemic lays the ground for a potential kind of revolution in impact investing and a transformation of what capitalism might look like in future.
We went into this crisis with a lot of social unrest around something which has become increasingly visible now, which is that a big chunk of our population has just been left behind for 25 years without any increase in real income, while those who were lucky enough to have a role to play in technology or finance benefited from conditions that enabled them to accumulate huge wealth. This threatens the cohesion of our society. It's one of the reasons for the Brexit referendum result, these frustrations about being left behind. I think impact investment has the potential at a time when COVID is going to be exacerbating these inequalities because of unemployment and the fact that big companies have learned to slim down and will stay slim down, to reduce these inequalities by steering investment to organizations that are capable of helping to absorb this unemployment, to train those who have been unemployed, to take them into jobs, to create companies that are capable of serving the communities that are left behind, to fund charitable organizations through investment, to help the most vulnerable. If we want to have a just and sustainable recovery, I think impact is central to it.
Okay, I think that's a perfect note to end on, Ronnie. Thank you so much for giving us a sense of a way forward. And I very much hope that your book has huge impact.
Thank you very much.
And thank you very much for joining us. And thank you all to the audience for your questions and for participating in this event. Everyone do take care and enjoy the book and act on its analysis.
Thank you, Minouche. It's been wonderful to be in a conversation with you.
Pleasure.
And thank you all for joining.
Take care.
Goodbye. Thank you.
Good night, everyone. Goodbye.